silver actually is a very, very interesting play. Measure it against gold. I mean, as gold goes up, silver tends to go up twice as fast. This is nonsense. This is absolute nonsense. We're looking actually, because government debt is now unfundable. That's the point about a debt trap. They cannot fund it. The entire collapse of the fiat currencies. There is no reason at all why China doesn't replicate that. And if she has a yuan tied to gold, President Xi and China, they will go ahead. They will make even greater strides. The press, the mainstream media merely repeats what the government wants it to repeat. But still, credit is credit, gold is money. Gold in possession is money. The risk in credit is mounting, and it's mounting very, very rapidly. And you don't want to be in credit. You want to be out of credit, from that risk into safety. And safety, the sensible safety, always is physical gold. Don't tell anyone you've got it. Keep quiet and preserve your wealth. But it's credit going down. It's the purchasing power of the currency going down, not prices rising. So get wise to that as soon as you possibly can.
And what would be your thought on silver, poor man's gold?
Silver, nowadays, central banks regard gold as money a lot more so than silver. And silver really since about the 1870s, in Europe anyway, it was initially, and you had some countries on silver standard, but after that, basically silver's position was relegated to a subordinate position as money. I mean, we had silver coins, for example, in circulation. Copper, we had copper coins for the same reason in circulation. So that was sort of down another notch in terms of being subordinate, if you like, to gold. Silver, however, does have enormous industrial properties. And there are influences, if you like, on silver, which aren't strictly monetary at the moment. It can be a speculative counter. And if you want to wander into a little bit of speculation within the money context, then fine. And at current levels, I would think that silver actually is a very, very interesting play. Measure it against gold. I mean, as gold goes up, silver tends to go up twice as fast. So if you understand what I'm trying to say about what the difference between money and credit is, it does make sense to have some silver. And I think that silver also, we've had this supply deficit for a very, very long time. China has turned around from being a major exporter of silver to suppress the price to being, if you like, they're withdrawn from exporting silver. And so far as we can see in this year so far, the only official statistics suggest that silver has been a major, major import of China.
Silver's real threat may not be its price, its physical supply disappearing behind it. As Alasdair Macleod points out here, China shifted from major silver exporter to major importer, while silver faces persistent supply deficits. Industrial demand competes with monetary demand, leaving less available when investors rush in. For silver holders, scarcity can amplify moves dramatically. Next, Alasdair Macleod exposes why China's changing silver flows could matter more than Western price signals.
It just turned around from being a major exporter, like 3,000 to 5,000 tons every year since 2020, to earlier this year, I think in the first quarter, they imported something like 1,628 tons. We don't have export figures. For some reason, that's being withheld or doesn't exist. I don't know. So that's turned around. And I think this will put the squeeze again on silver. I mean, note that last year, you had various steps whereby China restricted its export of rare earths. What we didn't know at the time was she seemed to be following a similar policy on silver. I'm talking about the second half of last year. We first discovered this, I think it was on October the 8th or 9th, when in London, suddenly the lease rate shot up 40% because there was no silver. There was no liquidity in the market. Now, at that time, silver was a little less than $50 an ounce. It shot up quite rapidly from October to, sort of into January, up to that peak of 120. That is what happened when the market gets short of silver. I suspect we're facing a similar situation developing in silver today. And I can see silver easily shooting well past that level. But I think, given that I regard, all fiat currencies as really in their end of life, if you like, then I think the way you really ought to look at it is in terms of what is the silver price going to be doing in gold. So the silver ratio is probably the thing to watch. At the moment, I think it's around about 70. I haven't looked at it that closely, but I can easily see that coming down to below 40 in the relatively near term, and possibly even lower than that, down into the low 30s, maybe the upper 20s. After that, we reassess. As a more general point, it's worth noting that the purchasing power of gold over long periods of time is relatively constant.
The most dangerous silver signal may appear before price breaks higher, when physical liquidity vanishes. According to Alasdair Macleod, London lease rates surged roughly 40% when silver became scarce, preceding a move from below $50 toward $120. The question is whether today's market repeats that setup while the gold-silver ratio remains elevated. Investors watching spot prices could miss the squeeze. Next, Alasdair Macleod unravels why the ratio could become silver's real signal.
And if there are any variations, they tend to come from the fiat currency side. Now, that constancy means that if you look at a basket of commodities, base metals, whatever, and price it in gold, then you should see some constancy in terms of value over long periods of time. I mean, individual commodities will come and go, but a sort of basket with a sort of wide bunch of these things should be relatively stable. So if money holds its value and credit loses its value, then you will find that commodities will be rising in price, apparently. But as I said earlier, it's actually a question of the currency's purchasing power going down. But we should see some stability, if you like, in the relationship, continuing stability. We've got a 2,000-year history on this, between the value of gold and the value of commodities. So that's another thing I think to think of. And I suspect that eventually China will put itself on the gold standard to stop going down the drain along with the rest of us. And that's not a bad thing. I mean, in the 19th century, this country, the UK, became the most important country in the world. I mean, a population of that time of something like 19 million people effectively ruled the world in commercial terms. Over 80% of the ships afloat before the First World War were built in Britain. We had the largest merchant navy fleet, etc. Now, of course, everybody turns around and says, well, you had colonies and all this captive markets and so on. Well, maybe, but it was free trade. Just think on that. And, there is no reason at all why China doesn't replicate that. And if she has a yuan tied to gold, then Prime Minister, President Xi and China, they will go ahead. They will make even greater strides. They will bring the rest of the world into an industrial revolution, which we enjoyed 150 years ago.
If your currency loses purchasing power while gold stays stable, the rising price illusion hides the real wealth destruction. What Alasdair Macleod is highlighting is that commodities can remain relatively stable when measured against gold, even as fiat currencies deteriorate. That reframes inflation as currency debasement rather than genuine commodity appreciation. For savers, The danger is preserving nominal dollars while losing what those dollars can actually buy. Next, Alasdair Macleod exposes why China's gold strategy could challenge the existing monetary order.
That's the dynamic which she can create out of the ashes of our own destruction. It's going to be exciting times, but I mean, the idea that, we're going to suddenly think, currency goes to zero. Everybody realizes how stupid we've been. Okay, it's the end of the welfare state. Small government's got to come and, just don't interfere in the economy. Dream on. Because as Hayek wrote in his Road to Serfdom, after the sort of crisis, currency crisis we get, they'll be clamoring for a strong leader. We need a strong leader, they'll be saying. And they got Hitler. Germany got Hitler. Getting out of this is not necessarily going to be easy, and this assumes we don't have World War III. You could argue that we're already World War III, but, if this intensifies too much, and particularly if Israel loses the patronage or the control, patronage over America, then don't rule out nuclear weapons. But that, I think, is something which we can't consider at this moment. This is nonsense. This is absolute nonsense. We're looking actually, because, government debt is now unfundable. That's the point about a debt trap. They cannot fund it. We face the entire collapse of the fiat currencies. And so this is why for some considerable time, I've been telling people, get the hell out of credit and get into real money without counterparty risk, which is only physical gold. And you could argue the same for physical silver.
Why do you think that the media is able to try and showcase that the Fed could just keep kicking the can down the road?
I'll tell you, the answer is so simple. If you have a journalist, everything works on ground briefings. Yep. If you have a journalist who actually is off message, he's not invited into the background briefings.
The real risk is not a sudden currency collapse. It is the slow normalization of impossible government debt. Macleod's argument suggests that unfundable debt forces investors toward assets without counterparty risk, while media narratives can make monetary stress appear manageable. That creates a dangerous mismatch between what policymakers need markets to believe and what debt mathematics permits. Next, Alasdair Macleod reveals how the information pipeline itself can keep investors blind to the debt trap.
His editor, he's absolutely useless as far as his editor is concerned. This is the way in which the press is controlled. So the press, the mainstream media, merely repeats what the government wants it to repeat, for fear of, if I don't say what the government, if I don't write what the government tells me, then I'll be on the banned list. Quite simple. That's the way it works.
Something that I want to focus on, Alasdair, is you've been a stockbroker where, at the time you were focused on making money, and money is a tool and it is part of our life. But you made the decision, obviously, to start focusing more on education. And you've been doing that for a long time now. What has been your driver behind doing that? And how could you continue to help not even just hundreds, but even thousands and maybe even millions of people continue to be more educated?
Well, that is my mission as it happens, because I haven't just been a stockbroker. I've also been an investment manager, so I know what it is to have responsibility for managing other people's assets. And I've also been a director of a bank, so I understand creation of credit and things like that, which actually is not understood by many economists.
Why?
There's so much BS talks about, macroeconomics and so on, which is a non-science. It really is. Trying to model things and all the rest of it, it just does not work, because it doesn't cater for one very, very important thing. In fact, it's the central thing. That is, it all depends on human action. And the day you can predict human action, I think it will be because humanity is dead and there is no action. So you can predict it on that basis. But until then, you cannot predict human action. So, it's educating people to understand where all the BS is in the mainstream media, in investment strategies, in economists, what the governments tell you to.
The most dangerous financial narrative is the one investors stop questioning because every headline repeats it. This is where Alasdair Macleod's thesis shifts from markets to incentives. Journalists, economists, and policymakers operate within systems that reward conformity, while human behavior remains impossible to model precisely. That matters because financial forecasts can look scientific, while resting on assumptions markets routinely destroy. Next, Alasdair Macleod unravels why understanding credit may matter more than trusting economic forecasts.
And all this sort of stuff. So I try and cut through that in language which is understandable. And the other thing which I think is terribly important is really, as I said earlier, to understand the difference between credit and money. And the great John Pierpont Morgan described this back in 1912. He said, gold is money and all else is credit. And he was absolutely right. And this is a principle that goes all the way back to early Roman law. I mean, it was first set out in the 12 tables or tablets in 448 BC. We're talking about, 2,500 years ago. And that's the way it still works. Okay, banking has innovated, it has changed, it's gone through various crises, all the rest of it. But still, credit is credit, gold is money. Gold in possession is money. That's the key thing to understand. And most of the time, you don't want to own gold because you're tying up capital or wealth, if you like, in something which is non-productive. And what you do is you play the credit game. And you've got to understand the credit game, and then you can make lots and lots and lots of, wealth, if you like. I was going to say money, but it's not. Credit is not money. You can make lots and lots of wealth. But there comes a time, and this is it now. There comes a time when the risk in credit is mounting, and it's mounting very, very rapidly. And you don't want to be in credit. You want to be out of credit, from that risk, and into safety. And safety, the sensible safety, always is physical gold. Whether it's gold coin in jurisdictions where there isn't a huge premium for coin, and you get tax benefits in the sense there's no capital gains tax on coin, as is the situation in the UK. Generally, bullion is free of sales taxes. Most jurisdictions have it.
Gold's biggest advantage appears when investors discover that money and credit were never the same thing. Alasdair Macleod notes that credit can create substantial wealth during normal conditions, but its risk accelerates when confidence deteriorates. Physical gold is different because it carries no issuer's promise to repay. For conservative investors, that distinction becomes crucial when financial assets depend on increasingly fragile counterparties. Next, Alasdair Macleod exposes the moment when the credit game stops rewarding patience and starts punishing exposure.
Don't tell anyone you've got it. Keep quiet and preserve your wealth. Don't try and accumulate wealth anymore. Those days are over. And the shock that I see in markets from bond yields, government bond yields, shooting up through that 5% level, that will collapse the bubble in equities, that is for sure. Where there is something like 25 trillion of foreign money invested, do you think they're going to hang around? Well, the market goes down. No, they're going to get out. They won't get 25 trillion out, I can tell you. But you're going to have a lot of sellers once that bubble pops. And it'll probably start with the banks because they've got collateral. The collateral they have is. But if you look at through the banking system and also through repos and all the rest of it, you're looking at collateral totally. including brokers' collateral, you're looking at about $9 trillion of credit ramping the equity market. That'll all be sold. So you want to get out of credit. Credit includes currency, fiat currencies. And they're on their way to zero, basically. China is protecting herself. She's bought a lot of gold. She's put into existence a mechanism whereby she can literally fix the yuan rate to gold overnight. Russia is the same. But as for the rest of us, we've sold ourselves to the Keynesian devils, and we will reap the reward in hell. Unless you know the difference between money and credit, which very few people do, incidentally.
A 5% government bond yield could become the trigger that forces leveraged equity holders to rethink everything. According to Alasdair Macleod, roughly $9 trillion of credit supports the equity market through banking, repos, and collateral structures, creating forced selling risk if financing conditions tighten. That means a correction could become mechanical rather than emotional, with institutions selling because the system demands liquidity.